this is a real problem for the Fed. They can't have another bank crisis, meaning their only alternative is to liquefy again. And that's what gold knows. That's what gold ultimately responds to, is the degradation of the money unit, meaning the liquefaction of the system. And so gold knows that. And that's why, even though banks have rallied, gold has not caved. Okay. We had a good surge into early 2023 and then this protracted pullback. And now we're sitting up there. How come we're still sitting up at the highs in gold, basically, while the banks have had a rally? Gold knows better. It knows the bank rally is not sustainable.
After much speculation about the intention of the U.S. Federal Reserve regarding the Bank Term Funding Program, the Apex Bank has announced that the program will end as scheduled in March. Recall that the lending program was introduced in the wake of the regional banking crisis in 2023 to provide longer-term loans to banks and other eligible institutions using Treasury securities and other government-backed securities as collateral. Last year, due to the Fed's unprecedented rate hikes, the market values of these securities fell significantly, necessitating the central bank to swing into action. The program has provided relief and much-needed funding to these financial institutions for several months now. However, more recently, it has also opened up a profitable arbitrage opportunity for eligible financial institutions because of the lower interest rates. The arbitrage opportunity arose from the difference in interest rates. Banks can borrow from the BTFP at a lower rate and invest this capital in other financial instruments or loans that yield a higher rate, opening up arbitrage opportunities. According to the Fed's announcement, that opportunity has also ended, as the BTFP interest rate will be increased to match the interest rate on reserve balances. In its announcement, the Apex Bank said, "The interest rate applicable to new BTFP loans has been adjusted such that the rate on new loans extended from now through program expiration will be no lower than the interest rate on reserve balances in effect on the day the loan is made." According to renowned metals analyst Michael Oliver, it is yet to be seen if the Federal Reserve can really end the program even with such a high risk of another banking sector crisis. Oliver believes the Fed will be forced to introduce some much-needed liquidity into the system in 2024, which will, of course, be great for gold and silver prices. We will now bring you clips from Michael Oliver's recent interview with Liberty and Finance. As we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos with Oliver and other expert analysts and investors. Thanks, and enjoy the video.
Well, the gold market had that surge December 3rd or 4th, the first day of the December, where you went up and finally hit the stops, the buy stops, no doubt, shorts covering their losing positions, late longs coming in at 2,100. Okay. And you gushed within 45 minutes up to 2,150. Why? Because it was one, it was in the dark. Two, it had to be a massive amount of buy stops there. And so they were elected and it just whooshed. Okay. But once all that buying dissipated, literally within that first hour, it was probably a void below. And so anybody who came in and sold, and I think the BIS actually did sell, dropped it immediately back down. And within 6 days of that high, gold traded down to 1980. Okay. Since then, gold launched back up to the upper 2000s and has never taken out that 1980 low that we made 6 days after that high. So you could basically take early December, second week of December, and we've been caught in between since then. A lot of selling, but this time, unlike last year, March to October, where it went down, a couple $100, or that 2022 drop, it dropped 20%. This time the selling has just created wheel spinning. Okay. And I think the bears have run out of the clock. I think, they needed to do more than they did. And all of a sudden yesterday, if you'll notice, while gold is still spinning here in the lower 2000s, silver shot up $1. Very interesting, very curious. And the miners have begun to stabilize again. And of course, they're always lagged to gold. At some point, they won't be. So pay attention to that. We measure that and we issue that in our reports. But I think gold is doing well. It's hanging in there despite the constant doubters. And they are abundant, even among the gold bulls. And I would say that this next upturn that we're probably on the cusp of right now, the next daily, weekly upturn, could be the one that engages us. And I would give you a number. You get much back over 2,100 gold again?
I'm wondering if there might be some misplaced confidence as well in the stock market as we're seeing all-time highs here.
We think it's entirely extremely limited leadership. It's mostly tech, almost all tech. In fact, it's a narrow segment of the tech sector that has made all-time new highs. In fact, if you look at XLK, which is the tech ETF, only 25 of the 61 stocks at our last measurement have made a new high. So even only about a third or 40% of that tech sector has marginally taken out the 21, 22 highs. NASDAQ 100 has nipped it out by a couple percentage points. No big deal. It's 2021 high. S&P has only marginally taken out its high by a percent or two. But when you look within the indexes, you'll see the stocks that did it are like Apple, Microsoft, NVIDIA, and when you go, I suggest to all your listeners and watchers that they go to their quote screens and type in a bunch of ETFs of sectors within the S&P that aren't tech. Example, XLP, consumer staples. XLY, consumer discretionary, which used to be a leading sector all during the bull market from 2009 to 2021. It's only 2/3 of the way back to its high. Look at retail, XRT. It's laying there dead comatose, 50% back toward its high, but just comatose. Despite all the talk we hear about, the consumer is strong. If you look within the stock market, you'll see it is exceptionally narrow, and that is not good for the bulls. Plus, our technical assessment of the leading stocks and the minor tech sectors that are leading this is that they're extremely vulnerable for a downturn. They're in what looks like a blow-off type mode. And when those things turn, they often turn savagely. And we're trying to measure that, the timing of that.
Save for a brief period between December 11th and 13, 2023, gold prices have remained above $2,000 since late November. That's about 2 months spent above this critical price level. Experts suggest that instead of being a resistance level, the $2,000 level has become a support level from which the next leg of the bull market will be launched. Oliver also believes that gold senses the impending chaos and instability in the market, and that's why prices have been so stable. When the rest of the market realizes what's coming, there will be a huge rush toward gold, leading to further price increases. Let's get back to the interview.
Yeah, I think gold is not a follower market. A lot of people think, well, if this government data point does this, gold will sell off. Gold has been around 3,000 years. Okay, UST bond's been around, 100 years, something like that. And the stock S&P has been around since the 1950s. Okay, it's an old and wise market. It's always been money. It still is. It anticipates macro events. It doesn't wait for headlines. And yes, you're right. Back last spring, the banks had a crash, literally a dimensional crash where in a number of weeks drop, 30-something%, that's a crash. We called that in late January. MSA had a technical reason. We didn't explain why. We didn't know why, but we could see they were going to collapse. And they've been an outperforming sector then. We're talking early 2023 now. And sure enough, in February, March, they hit our trigger numbers and crashed. Since then, we've had this crawl back based on, the Fed's going to take care of things. Don't worry about it. Okay, well, we'll see. Meanwhile, banks aren't back at their highs. Okay, they're not doing what the S&P's doing. So we're watching them very closely. And Brett's observations are dead on. This is a real problem for the Fed. They can't have another bank crisis, meaning their only alternative is to liquefy again. And that's what gold knows. That's what gold ultimately responds to, is the degradation of the money unit, meaning the liquefaction of the system. And so gold knows that. And that's why even though banks have rallied, gold has not caved. Okay. We had a good surge into early 2023 and then this protracted pullback. And now we're sitting up there. How come we're still sitting up at the highs in gold, basically, while the banks have had a rally? Gold knows better. It knows the bank rally is not sustainable. And I would also watch the broader financial sectors as well, not just the banks. I know everybody's looking at that, but watch for example, XLF is a good ETF to watch for the broad financials. But the Fed is very nervous about this. They have to be. And the other thing they're nervous about is their T-bond market. It crashed last year. We called the nuke event, and sure enough, in August, September, and October, the T-bond market went down in a crash mode. Rates went up to new highs, took out the low of the price low of October 2022 vastly in October of 2023. It was an uncontrolled decline, and that had to panic the Fed. And I'm sure they probably came in and helped support that market in the dark. But now that market has already given back a third of its gains, price gains, T-bond market. They got to get a little antsy right now. So what does that mean? Well, if they get antsy, that means somewhere down the road here, probably sooner than you think, data points or no data points, they're going to have to reliquefy. That's what gold knows.
Almost all experts are predicting significant price increases for gold, silver, and other commodities in 2024. Financial services giant UBS is also predicting a 10% increase in gold prices in 2024. According to a recent report from the multinational investment bank and financial services company, gold prices could close the year as much as 10% above current levels on the back of potential interest rate cuts. Do you agree with the UBS analysts or experts calling for more price gains? Please drop your comments in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.